welcome to Strictly Money at the News Forum, where all voices matter. I'm Saijal Patel. Are your 2021 taxes done and filed? If not, you have still some time to get it done. And you're in luck because my next guest has some tax tips to make sure you do it right so you pay less taxes and keep more for yourself. Brian Quinlan is partner at Campbell Lawless Chartered Professional Accountants, and he joins me now. Hi, Brian. Great to have you on.
Hi. Great. Thanks. Okay.
So deadline is around the corner, and we should probably remind viewers why it's important to file their tax returns on time.
Okay. Well, the first thing is we've got an extra 2 days this year because April 30th lands on a Saturday. So we have until May 2nd for your liability. And that's important because most people have to file by April 30th or this year, May 2nd. Self-employed people have until June 15th to file, actually. But what people sometimes forget, everyone's money is due on May 2nd. So it's important, even if you can't get your return done, do your best estimate of tax and make that payment. So that's what the first thing would be, is to make sure you, if you can't file on time, make your payment in time, kind of thing. And going from that, I would say it would still be nice to file on time, because if you do file late, there's an automatic 5% penalty if there's an amount owing. So it's important to either pay what you think you owe or definitely file on time to avoid penalties and interest.
And Brian, even if you don't owe money, it's still important to file on time, right? Because you could receive credits and benefits that you otherwise wouldn't.
It is. I think the federal government's been running TV ads this season to file for, so you'll get your GST credits and things like that, are all based on household income. So it is important to file. And even if you don't owe, some investors with over more than $100,000 of foreign investments, that form to disclose that is due on May 2nd this year. So nothing to do with tax. It's just a filing of a form deadline, that T1135. You don't want to be late with that form. So again, it's important to file on time. As you say, even if you don't know, and CRA could come back and say you do owe, and then you'd be in a penalty position.
Right. Okay. So for 2021, the filing season, what's new this year? What do Canadians have to be aware of? Because I know there's a laundry list of things.
The biggest question always is, well, I had to work at home for COVID, as we all have for the last two years, I guess. The home office expense that can be written off this year is $500 deduction. Last year it was only $400 because we didn't have a full COVID year. But this year it's $500 if you were at home working every day for your job. So there's a little bit of a tax kick or a tax deduction, help cover some of your utilities and home office expenses and things like that. So
okay, what about COVID relief for those who got a payment?
Unfortunately, well, it's good you received the payment, but just like we would have said last year, all those benefits received are taxable. So the government would have sent you out a T4A slip, and this year was better than last year because the government did withhold on those payments, where last year they didn't withhold as much. So a lot of people had a surprise last April, having this tax liability. People could still have a surprise this April 30th, hopefully not as big as they had one last year, though. So, but all the COVID benefits are taxable.
Okay. And same thing, if I'm correct, with the one-time payment to seniors. Is that right?
That's right. That was kind of a government gift of $500 to older seniors this year who qualify for the old age security. But it is taxable, and you should have received a T4A from the government of Canada, but it is taxable. So it wasn't a completely $500 gift. It's $500 before tax.
Okay. Now this show airs across Canada, but I do have to ask, as an Ontarian,
Yes.
there was a special announcement about staycations, for those who traveled locally. Can you talk about that, the Staycation Credit, and how that works?
Again, an incentive for people to travel. For us, I'm in Ontario as well, to travel in Ontario and write off some of your hotel bills and your travel and things like that. So a bit of a kicker really for the Ontario tourism industry. So if you're going to travel in Ontario and keep your receipts for your tax return.
Okay. Do any of these credits that we've just talked about get extended to next year that we should be aware of?
Most of the credits do go. Most credits, when they brought into the act, are coming. We don't know what's going to happen with COVID, as the COVID home office expense. It may be much lower last year. The government says COVID kind of ended now, say April. maybe we'll get a small home office expense. It's supposed to be 500 for a full year. Maybe it'll be 100 kind of thing. So, but all the other credits that we have right now are designed mostly to fall into next year as well, which is good
Okay,
news.
great. We're going to take a quick break and we'll continue this conversation when we come back. Welcome back. Brian, I want to continue our conversation about tax filing, but specifically ways to save on taxes. One of them is pension splitting, right? How can couples take advantage of this, number one? And what mistakes do you often see them make?
Great. Pension splitting is something I think has probably been around for about 10 years now, and it's a very virile tax planning thing. One, because it's so easy. You don't have to money change or deposit to your spouse or things like that. It's just strictly mathematical on your tax returns. So what pension splitting is you have two seniors, one's receiving a pension. Let's say one's in a high tax bracket, one's in a low tax bracket. We can take up to 50% of that pension from one spouse and put it on the other spouse's tax return. So effectively, all the income is still taxed, but at a lower rate. So in the example where, let's say, one spouse very, very high income and the other spouse is very, very low income, it works and can save thousands of dollars in income tax. And it's very, very easy to do because it's all basically how you do your tax return. So it's a great tax saving for seniors where the tax brackets of, say, a husband and wife or two partners are quite different.
Okay. Well, what sort of mistakes do you see people make when it comes to that?
The biggest mistake, people think what pension is, what's eligible for pension splitting. Okay. It does not include the old age security, and it does not include Canada Pension, which is a bit confusing because we always hear about splitting Canada Pension with your spouse and things like that, which you can do. I think CRA refers that to Canada Pension sharing or CPP sharing. That's when you have to call Service Canada, and that's where they would start giving you half your CPP and giving your spouse the other half kind of thing. But so this is really, most people, it's for payments from a registered pension plan or payments from your RIF would qualify for pension splitting. That's the main thing is people think OAS or CPP do as well.
Yeah, I can understand why they might think that. For those, Brian, who contributed to an RRSP, any tips?
I think yes. Okay. I believe in RRSPs as well. So, but the thing is, you can contribute 1 year. You don't have to take your deduction all in the same year as well. You can save that deduction. So if you know you're going into perhaps a higher tax bracket in 2022 versus what you were in 2021, you may want to save that deduction for when you do a year from now, when you do your tax return a year from now. So always think when you want to deduct, when your tax brackets are going up, the deduction is more valuable to you in terms of tax savings by perhaps saving it.
Yeah. Brian, the federal budget was announced on April 7th. Anything stand out to you?
Well, it's nice to see the government really is attacking the difficulty of buying a home, especially your first home. So there's now, I guess, a first home buyer's plan that will be starting up with the banks and trust companies probably in 2023, where you can start putting money away and get a tax deduction for it and take it out tax-free to purchase a home. So that's coming up nice. So that's one thing. The government really is starting to move on helping people buy that first home. Very positive incentive there.
Yeah, and it's a combination, isn't it? Because you get the tax deduction up front and you can pull it out. Were you surprised that they created sort of this new account and not just leverage what's there?
A bit surprising because now we have a couple of accounts. We still have the RSP home buyers plan, which is when you put money in your RSP money, you can take out the first $35,000 and put towards your first home. So both plans will still be going on together. They do contradict each other a bit because you can't withdraw from both plans to purchase the same house kind of thing or purchase a house. So that's one thing. So there still is two separate plans. The new one is I guess, the best of two worlds. You get a tax deduction and the rest of it's tax free. So it's like a savings plan on steroids, as people call it. So it's quite powerful. It's going to be quite an incentive for people to put money away for a home.
Yeah. Brian, we have about a minute left. For those who are looking now forward, what sort of tax planning tips do you have
Okay.
and advice?
Very, very good plan. People always say, I'm doing my 2021 tax return now. It's due on May 2nd, as we discussed. What tax planning can I do? And the answer is very, very little. We talked about pension splitting, easy to do because it's strictly math. But going forward, I think it's what you, when you're doing your 2021 return, what can you do now or the next, say, 10 months before the year, I guess 8 months before the year is over, to minimize your tax as well as your spouse's and perhaps your children's, the whole family's tax bill, whether that's income splitting, maybe zeroing in on more RSP contributions, saving for that home buyer's plan loan, or things like that. So what can you do now or over the next 8 months to save your tax bill a year from now?
Okay, Brian, we really appreciate your time. Thanks for coming on today.
Anytime. Thank you.
Welcome back to Strictly Money. If you own a home or are looking to buy a home, then there's a very good chance you're keeping a very close eye on mortgage rates. The 5-year fix recently faced its biggest rise in more than 20 years. And judging by the recent Bank of Canada comments stating that higher inflation is here for longer than any of us want, it's a safe bet that more rate hikes are on the way. David Larock is president of Integrated Mortgage Planners, and he joins me now to discuss rates and housing affordability. Hi, David. Great to have you on.
Hi, Saijal.
So we're not seeing any signs that inflation is abating, and having seen the recent comments, I guess, from Bank of Canada, anything surprise you there?
No, I think the Bank of Canada had to acknowledge the obvious, which is that inflation was not proving to be transitory. In their defense, they didn't anticipate the war in Ukraine, and there are a lot of factors that have conspired to make their original calls incorrect, as was the case for many people. I think it was surprising that the bank was adamant that more rate hikes were coming, and that they were so strong in that warning, because we've got record levels of debt outstanding, and it's not clear what the impact of each rate hike will be, but it's certainly likely that those impacts will be magnified. And the bank has just gotten done telling us that it's not going to give us forward guidance anymore. And it sure sounded a lot like forward guidance in the language that they used, but it wasn't the kind of forward guidance we're used to hearing.
Mm-hmm. David, they really are. It feels like they are in a tough position, right? Because if they raise rates too fast, we risk the fact of we risk an economic slowdown, and nobody really wants that. And the fact is, we've been addicted to cheap debt for a very long time.
That's right. The Bank of Canada, the central banks have no good options left. The challenge they've got is if they raise rates, that will slow demand and could crush demand. But in reality, the main causes of inflationary pressures are on the supply side. So they're trying to put a round peg into a square hole to staunch the leak, and it is a blunt tool for the job. The challenge, though, is inflation expectations are becoming what the bank calls unanchored, meaning that people are beginning to plan for higher inflation for a longer period of time. And if you're the Bank of Canada, nothing else comes close to mattering as much as those unanchored inflation expectations. So they're in a corner right now, and at this point, it's basically come heck or high water. They've got to bring inflation expectations back under control, and they've got to do what they can to bring inflation back under control. Even though, again, monetary policy is not well suited to help with supply challenges. So they're doing the best they can, but their rate hikes are not the best tool for the job.
Yeah, those expectations can lead to self-fulfilling prophecies, as we know. So, David, what do you think this means for the? I want to talk about demand and supply for housing, but what do you think this means for the demand side for housing? Are you expecting a slowdown?
Absolutely. I'm already seeing it. If you're a buyer right now and you see that fixed rates have already increased but more sharply than they have in the past 2 decades, the Bank of Canada has raised by 0.75%, and they've said we're not done by a long shot. Certainly buyers are saying, you know what, I don't know what the impact is going to be on the housing market, but I'm not nearly in the hurry that I was. And granted, if you're a buyer with a pre-approval rate that's expiring in June, you might still have a 3% fixed rate and be looking at a 4% fixed rate if that pre-approval expires. So over the very short term, there will be some buyers looking to get into the market while that pre-approval with the really low rate they have is still active.
Yeah.
But I think a lot of buyers are being more cautious now, absolutely. A lot of offer nights aren't getting any offers. I'm actually seeing purchase and sale agreements with financing conditions now, which for a Toronto mortgage broker, I haven't seen in the better part of a decade.
Wow.
They used to be as rare as hen's teeth. So definitely, I think the market is changing. I don't think it's clear that we're going from a seller's market to a buyer's market, but I think we're definitely in transition. And at this point, the market is changing for sure.
Okay. We only have 20 seconds left. Do you still think, I know the last time you came on, you thought variable was still the way to go versus fixed? Still feel that way?
I think if the Bank of Canada increases too much, we'll get a recession, and I think rates will fall on the other side of the recession. So over the next 5 years, I think variable rates are still a good bet to save money over fixed rates, but there's a lot more uncertainty in that call this time than the last time we spoke.
Okay, we'll take a quick break. We'll be right back. Welcome back. David, I want to get your thoughts on the proposals released in the 2022 federal budget, specifically to address housing affordability. And let's start with this $4 billion accelerator fund to address supply. Thoughts?
A lot of smoke. The federal government certainly touted their budget as being very much focused on dealing with housing affordability. But when I wrote a blog about it, and when I got into the brass tacks, I was left wholly unimpressed. $4 billion is a good sounding number, but the problem that they've got is the municipalities and the provinces control a lot of the approval processes that are slowing down new construction, and they've earmarked this money, but how are they going to spend it? There weren't a lot of details on that. To me, it was just all puffery. There wasn't anything behind it. If they had said, we're going to create an infrastructure fund and there's $4 billion in it, and the municipalities that get behind the program and use the money first will get the money, and those that are slow won't. That kind of thing, I think, would have created a lot more traction in the market. But at this point, what they're saying is, well, we're gonna commit $4 billion to help the municipalities and encourage them to speed up their approval processes, but all of the politics at the municipal level favors slowing down approval processes. If you're a municipal politician, you want to get elected, try explaining to your residents why approving a whole bunch of new dense housing developments in their low density single family neighborhoods is good for them, and then ask them to vote for you again. It's a very complicated situation, and there's a reason the problem has existed for a long time. And I don't think the $4 billion pledge, I don't think that money will ever be spent in totality. And ultimately, there wasn't a lot of detail about how they were going to use the money. And really, the devil is always in the detail with these things.
Absolutely, no, and a lot of good points you make. What about this proposal to end blind bidding? Because that's getting a lot of attention. And I should remind viewers, this is a practice where buyers bid for a home without knowing the size of the competing offers. How do you feel about it?
I think we should absolutely do it. It's crazy to me that people are expected to make the biggest purchase of their life without knowing what price it will take to buy the asset. And in some cases, overpaying by huge amounts, basically because they were ignorant of the price they needed to pay. I don't think it's defensible. The arguments I've heard are that, well, there's no blind bidding in Australia and house prices there are still high and affordability there is still a challenge. Well, fair enough. But at the end of the day, ask anyone on the street if it's fair that they should be asked to bid on something so expensive as a house without knowing the price it would take to buy the house. And I just don't think there's a compelling argument against it. I think it's long overdue. And quite frankly, the only thing stopping it at this point is politics. And ultimately, I don't think history will be kind to the people who have opposed this change.
Yeah. Speaking of politics, I mean, Ontario seems to be sitting on the sidelines on this one, right? And yet there's this argument, well, blind bidding is good for sellers and sellers should have that option.
Sure, there are lots of things that are good for one side in a transaction that are really bad for people on the other side of the transaction. And to me, the way you determine whether or not something should change is you look at the fundamental fairness of it. And I think any person can look at the situation with blind bidding and say, well, should sellers have the right to create circumstances where buyers are at a disadvantage and at great risk of overpaying? And if the answer to that question is no, and I think it would be for most people, then the thing we should do next seems pretty obvious.
Okay. David, we have about 45 seconds left. What are you seeing in terms of inventory and the turnover? And the reason I ask for that is if supply is still tight, will higher rates actually have an impact on home prices?
Right now, supply is tight. There's no question. We still have, I think in the GT area, in the Toronto area right now, we have about a month's inventory, which is still considered quite tight. We need to get up to about 3 months, I think, before the market would seem more balanced. But this will be interesting. I saw a stat recently, about 30% of homeowners own more than one property. There's a lot of people who, when they moved up, held on to their previously owned property and are renting it out. And when rates go up, there's a lot of pressure on those homeowners, the homeowners of multiple properties, to unload one of them. And over the next 6 to 12 months, I think we might start to see that happen. And if we do, then that'll increase supply.
Okay. David, thanks for coming on today. Really appreciate it.
Thanks, Saijal.
Well, thanks for watching. We'll see you next time.